Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, August 5th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The chart that we will be working off of here is a weekly candlestick chart of the S&P 500. So each candlestick on this chart does represent 1 week of trading. And to start with, we're going to run the chart back to the beginning of 2021. Just gives us some nice perspective. Now, to start off with, let's take a look at what the S&P 500 did last week. We were up 36 basis points, 0.36%. And the S&P 500 closed at 4145.19. And, of course, you can see all of the information over here, but it is so small that I always annotate it and put it right there. Now, let's start off with this 4200 line, this blue line here, okay? So what's important here, guys, is the first time that the S&P 500 ever traded above 4200 was back on May 7th of 2021. So the reason this is important in the context of what we're talking about here and with respect to this recent counter trend rally, and we'll talk more about this, but I have to give you this setup here. So bear with me and watch this entire video, guys. This is going to be extremely educational. So we first got up to this 4200 level back on 5/7, and then you could see we had some consolidation, some sideways trading for several months there, about a month, 2.5 months. Back in 2021, and basically we've had about a year of trading from May of 2021 until May, April, basically the first part of May of 2022, we had trading above or right around the 4200 level, all right? So that provides a year of overhead resistance, right? A year of overhead supply above the 4200 level. Well, as you can see here, we haven't had the last week where there was any trading around the 4200 level. Above it was back here the first week in May of this year. You can see this this candle. Well, we can clearly see that the body of the candle closed under 4200, and the last weekly close we had above 4200 was this week right here that I'm circling in the middle of April of this year, all right? So every single week since this candle right here, as a matter of fact, what I'm going to do here, I'm going to pull up the annotation tool, and we'll start annotating this chart and seeing what we can learn together, all right? But that candle right there was the last weekly candle that closed above 4200, and as we can clearly see, that is in April of this year, all right? So what I'm going to do is I'm going to change the length of this chart now to be a 1-year chart, and let's do some more annotations and see what we can learn, all right? So the first thing here, let's take a look at a trend line, and we'll draw this on top of the bodies of the candles, right, connecting back to the first part of the year where we peaked. And we can see here on this part, save that annotation, we can see that here's the downtrend line, and we're still below that, all right? Now, we've had this nice counter trend rally since the June 17th. Now, it's harder to see on the weekly candles, but June 17th was the intraday low, 36 and change on the S&P 500, and we've had this rally since. Well, the other thing to note here, guys, is that we've only had 3 weeks in a row here, right, where the S&P 500 has been positive, and that was only the second time. Whoops. Get rid of that. Meant to grab this again and extend that out. But this was only the second time this calendar year where we've had 3 weeks in a row where the S&P 500 has been positive. All right, you can see these 3 weeks here, and here's these 3 weeks here. Well, the last time we had that 3-week rally, then the market rolled over and went lower. All right, And we can also clearly see that and again, I want to do these annotations live with you guys so you guys can see this and see this working and see how I do this, and hopefully enjoy that. But you can clearly see that this weekly candle here back in May, where I just put that arrow, closed a little higher than any of these last 3 weeks. All right, so we're stalling out actually below the 4150 level, but we've left this 4200 line, this blue line here. That's still that 4200 line, all right? And you can see again that there's been no weekly closes. Just to kind of recap what we've already talked about, no weekly closes above 4200 since back in the middle of April. We really have had no trading at all since this first week in May. No trading above 4200. All right, we're stalling out around 4150, so shy of that 4200 level. We know we have a year of overhead supply at 4200. We've only had 2 3-week rallies in the S&P 500 during the calendar year of 2022, one of which we just experienced. The last one was back in March, and then you have to go clear back to October of 2021 to get another 3+ week rally in the S&P 500. Okay, so you can see there's a couple of times back in December, 2 weeks negative, 2 weeks negative, 1 week negative. Then we had these 3 positive weeks in March, and then we fell. We had 1 positive week. We fell, 1 positive week, right? And so we've now had 3 positive weeks in the S&P 500. So look, guys, we don't know, right? People can take guesses and have opinions and everything, but we know, just based on overhead resistance, we're probably, if the market does continue to rally here, and it definitely could, up to and try to challenge this 4200 level, we know that we're going to be running up against 1 year, right? An entire year, basically, of overhead resistance. On the S&P 500, where people that maybe got in, somewhere between 4,200 and the peak in the market of 48,1862 back on January 4th. I don't have it annotated, but that is the peak in the market back here, January 4th of this year. I just have it memorized. So we know that we're going to have an entire year of overhead supply. So those people, that maybe got in right here or whatever, a lot of those may just want their money back, right? Oh, man, I just want to get my money back. So if the market does get up to 4,200 and start to challenge this area, we're going to have more and more sellers try to come in. So the higher the market goes, the more overhead supply we're going to run into. We're still in the downtrend, as we can see. Yes, we've had a nice counter trend rally, but let's also take a look here and use Fibonacci retracements, and I want to show you something here, all right? Now, let's look at the entire movement, and if you're familiar, whether you're familiar with Fibonacci or not, let me just kind of recap this for you. The most important, there's a lot of Fibonacci numbers, but the most important to remember are 38.2, 60, and 61.8, and then 50% retracement. It's not a pure, true Fibonacci number, but it does work quite well in technical trading, and again, that's 50%. Now, I know this chart is starting to get kind of busy, but bear with me here, and I hope you're looking at this on a larger screen because it will definitely help. So if we take a look at and again, here's where we drew the Fibonacci. You can see the numbers over here on the side, but where we peaked here at the beginning of January, right, January 4th, to where we bottomed intraday on June 17th, that is 100% of the move. Well, if we look at where we're at right now, we've retraced a little bit more than 38.2. You can see, I know it's small, but that's where my cursor is circling. We've retraced a little bit more than 38.2% of the entire move, all right? And let me maybe shorten this up here to, let's go to 0. Let's shorten this up to maybe 8 months, and it might be easier for you guys to see, all right? A little bit. All right. And so we can see here that the 50% retracement level is going to be around the 42.25 level. All right. And again, this blue line here is the 4,200. All right, so this middle one here where my cursor is circling, that's the 50% retracement. The point is, it's not uncommon, and I'll prove my point here in a second. But it's not uncommon whenever the market is falling, you fall, you retrace part of it. You fall, you retrace part of it. And what we've done here so far is we've retraced a little bit more than 38.2, but less than 50% of the entire move that happened from January 4th to June 17th. Hopefully this is making sense. But guys, this is how you do the analysis, all right? Now, let me get back in here and let's take this annotation tool, and I want to move back, and we're going to go back and take a look at the first leg of this downturn, right? Because I want you to understand something here. And we can see here that if we just focus on the move from January 4th to where the first bottom, if you will, right, was in February, and then how much of that we retraced, you can clearly see here that we retraced more than, I mean, look at this, guys. We retraced more than 61.8% of that entire move, all right? I mean, a lot of it. And then the market rolled over. So my point is that even though we've retraced over 38.2% of the entire downturn, you know, we retraced basically 2/3 of the downturn right here, and the market still rolled over and went lower. So it is completely possible and perhaps even plausible that this market is going to roll over and at least challenge the lows down here around that 36 level on the S&P 500 from June 17th and or go lower. All right. Now, let me get back into this annotation tool. As a matter of fact, to make this work, we're going to have to extend this chart out. So let's go back. Let's just change this to like 2.8 years. All right. It might get a little clunky here, but bear with me. This is the instead of me annotating the charts and then showing them to you, this is the process I go through. Just trying to do it live and do it in a fairly expedient time frame. But again, okay, here's that entire move, and you can see the bounces and all we've talked about. But what I want you to understand by looking at this longer term chart is that, well, and let's take this annotation tool and run it back, the Fibonacci retracement, and let's go back and let's take a look at the entire move, all right, from the COVID lows in March of, let me get back out of here so it's easier for you guys to see, where we bottomed in March of 2020, and of course we peaked January 4th of this year, and we can clearly see that if we have a 50%, again, not uncommon at all, right? This is the entire move, right? That the rally from the COVID lows to the January 4th peak in this year. There's the entire move. If we retrace 50% of that entire move, that takes us down to 3,500. Well, we can clearly see that between a 50% retracement and a 61.8% retracement, I need to invert this so it'll make complete sense. So I'm going to do this. Bear with me. This will make complete sense, guys. Once I'm done here, it should anyway. All right. So I just had to flip that Fibonacci tool on its head to make this work properly. So again, here's the entire rally, and if we retrace 50% of that, that's going to take us down to 3,500. Now you can clearly see that there's a lot of trading right up to that 3,500 level. Just amazing how well this Fibonacci stuff works, guys. And I'm telling you, you can back test it. I mean, it's just absolutely fascinating how well some of this stuff works. And it's, I mean, I'm only scratching the surface of this stuff, guys. It's, it works in galaxies, it works in seashells. I mean, it's just absolutely fascinating how this stuff works in nature, and it works in technical analysis. But we can clearly see here that if we retrace 61.8%, right, of this entire move, that would take us down to roughly 3,200. You can see that there is a ton of trading from back in 2020 where we peaked right around just below 3,400 just before the COVID downturn, and then we got back up to this area. But there's a ton of trading in this area during 2020 between 3,200 and 3,500. All right. So if the market rolls over, and I think there's a pretty high probability of that happening. Is it possible the 3636 level from June 17th is the low of the downturn? Yeah, it is completely possible. However, if that becomes the lows of the entire downturn, guys, it means we got really lucky. All right, it means we got really lucky because remember, and I'm not going to delve into this too much on this video, but I want you to understand in a really serious bear market like we had from 2000 through 03 and then 07 through 09, the S&P lost over 50%, over 50% of its value. Okay, the S&P 500 in both of those bear markets got cut in half. All right, so we were down a little bit more than 24% from peak to trough so far, about 24.5%. All right, from the January 14th high to the June 17th low. So what I'm saying here is so far our maximum drawdown has been less than half on a percentage basis, less than half of what we experienced as far as a drawdown percentage, less than half of what we experienced in the two bear markets that I just mentioned, 2000 through 03 and then 07 through 09. All right. So is it possible that that's low? Yeah, but it's also highly possible that the market rolls over here after hitting overhead resistance just under 4,200, somewhere around that 4,150 level, and then we go lower and we retrace at least, right, 50% of this entire move, which takes us down to 3,500. We can see that there's a lot of support right here at 3,500, but it's not uncommon at all for the market to fall lower than that, and, it would make a lot of sense from a technical standpoint, regardless of whether you're looking at support and resistance levels, Fibonacci retracements, whatever. It would make a lot of sense for the market to fall to somewhere between 3,200 and 3,500, before and perhaps even lower, guys. I mean, we could definitely go lower. All right. And I've got another video out there. If you haven't seen it, it's a longer video, but I annotated the whole thing for you like this to show you how I got to this, to these numbers. But if you want to see a lengthier version of what I'm doing right here, something I did, I think, clear back in February of this year. It's called How Low Will the S&P 500 Go? And you can go check that out. But it will show you if we get a drawdown similar to what we saw in 2000 through 03 and 07 through 09. It'll show you what could happen in in a really bad bear market. Now, with that said, I hope you appreciate the approach I'm taking here, guys. I'm not using hyperbole. I'm not using, the market crash and all that stuff. I hate that, all right? And I want to encourage you to avoid those channels and those videos that talk about market crashes, because everything's going to end up in a crash. And guys, look, we have to be more mature. We have to be more intelligent. We have to be more thoughtful. We have to be more technical than that. Remove the emotion. Use the market. Use math. Use the technical tools. Use things that make sense and things that we can quantify and understand and that are repeatable, okay? Now, you can't predict the market, but we can at least use statistical probabilities to look at an if this then that scenario. Okay, again, something I learned from studying very successful traders throughout the years. I've been at this for a long time. As you saw I'm a former financial advisor, former VP of a major mutual fund company. I developed my own proprietary risk management and trend direction program, and I do write a newsletter about that. I'll tee up more information at the end here. It's very cost effective, guys. It's something you really should take a serious look at if you want to work closer with me, if you want to become a better investor and trader, if you really want to understand how the stock market works. I can help you with that. But you have to take that first step, okay, by watching the balance of this video. So I hope you've enjoyed this. Again, we're at kind of an inflection point here, right? Could the market continue to go higher? Yes. But what we do understand, just to recap real quick, and then we'll wrap this up, is that we're going to start to run up against more and more overhead resistance, more and more overhead selling supply once we get closer to and perhaps above that 4,200 level, all right? But if the market does start to roll over, which, based on some other deeper stuff I was looking at over the last few days, I think that's highly probable. And again, especially since the last time we had more than 3 weeks in a row positive on the S&P 500 was clear back in October of last year. All right. So again, statistical probabilities tell us we're going to start probably running up against some selling, and anybody that wanted to buy or any algorithms that were set to buy, because much of the volume in the markets now is done by computers, right, because of algorithmic trading and high-frequency trading. But it's quite likely that we're going to run out of juice here. And also one last thing, August through October tend to be the worst 3 months of the year for the market. Over time, a lot of weird stuff can happen in the August through October time frame. It doesn't mean it has to be negative, right, August through October each year. But if you go back over the last 50, 60 years and look at the aggregate returns, right, the cumulative returns of the August through October timeframe, they're not good, right? So I'm always extremely respectful of the markets during the August through October timeframe, because some weird stuff, some bad stuff can happen. It doesn't mean it works like that every single year. But from a seasonality standpoint, it is the worst 3 months, historically, the worst 3 months of the year for the stock market, August through October. So we have to be super careful about that. And we're obviously just now in that August through October window. Make sure you subscribe to this channel so you don't miss any of my videos going forward, and stay with the balance of this video for some very important information that could make a huge difference in your life. Are you a business owner or a busy executive, including a doctor, dentist, attorney, or realtor? Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then simple market signals should be important to you as well. Simple market signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need simple market signals. Simple market signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple market signals is equity investing information simplified. Simple market signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.